Here's something they'll never teach you in finance school that could change your entire financial future. While retail investors lose fortunes during market crashes, a select group consistently builds generational wealth from chaos. The difference isn't luck, timing, or superior intelligence. It's access to a strategic framework most never discover. Today, I'm revealing the 5 specific asset classes that smart money accumulates while everyone else runs scared. These aren't theoretical concepts or academic theories. This is documented behavior from institutional investor filings spanning decades. The first asset sounds boring, but boring is exactly what generates extraordinary returns during market turmoil. Cash equivalents and short-term government securities become the ultimate weapon when everything else is bleeding. While media pundits criticize holding cash during inflation, smart money understands its true strategic value. Cash doesn't generate returns during the good times, but it generates options during the crisis. When assets drop 50% or more, having liquidity means buying quality companies at basement prices. Historical data shows institutional investors begin accumulating cash positions 18 to 24 months before crashes. This isn't market timing in the traditional sense. It's strategic positioning for inevitable cyclical opportunities. The second asset class is where things get controversial, because it directly profits from others' misfortune. Distressed securities represent ownership opportunities disguised as debt instruments trading at massive discounts. When companies approach bankruptcy, their bonds trade for pennies, while the underlying assets remain valuable. Sophisticated investors buy these distressed bonds, knowing bankruptcy court will convert debt into equity ownership. This legal mechanism allows purchasing entire companies for fractions of their asset value without paying market prices. During the last major recession, distressed debt funds generated returns exceeding 40% annually for participants. The third asset has been preserving wealth for thousands of years across every civilization and currency collapse. Productive farmland represents the ultimate inflation hedge because food demand remains constant regardless of economic conditions. Unlike financial assets, farmland produces actual goods that people need for survival, creating intrinsic value floors. During periods of currency debasement, productive land maintains purchasing power while paper assets disintegrate. Institutional investors have quietly accumulated millions of acres of prime agricultural real estate over recent decades. This isn't about hobby farming or environmental concerns. This is about owning the means of food production. The fourth asset class operates in a world most people never see, yet it consistently outperforms traditional investments. High-end collectibles and fine art show negative correlation to financial markets during periods of economic stress. When stock markets crash, art auctions continue because wealthy collectors view downturns as buying opportunities. Rare assets with fixed supply become wealth preservation vehicles when governments print unlimited amounts of currency. The scarcity factor creates mathematical advantage when monetary supply expands but collectible supply remains permanently fixed. Private sale data shows collectibles trading volumes spike significantly before major market corrections become public knowledge. The fifth asset category is where defensive strategy transforms into aggressive wealth building during economic chaos. Countercyclical businesses actually improve their market position when economic conditions deteriorate for everyone else. These companies provide essential services that people cannot eliminate regardless of personal financial circumstances.
Think about businesses where demand stays constant, but competition decreases as weaker operators fail. Debt collection, storage facilities, discount retailers, and repair services all benefit from increased economic hardship. During recessions, these businesses enjoy reduced labor costs while maintaining stable revenue streams from desperate customers. Now let's talk about timing, because getting the sequence wrong can destroy even the best strategic positioning. Smart money doesn't wait for crashes to begin positioning. They start building positions during the euphoria phase. When everyone else is celebrating market highs, sophisticated investors are quietly preparing for the inevitable downturn. Historical analysis shows these positioning moves typically begin 12 to 18 months before major corrections. The key is recognizing market cycle patterns rather than trying to predict specific timing of crash events. Asset allocation percentages matter less than understanding the psychological and structural forces driving each cycle. Let's examine the psychological component, because understanding crowd behavior is crucial for contrarian positioning success. During bull markets, risk tolerance expands beyond rational levels as success breeds dangerous overconfidence. Media coverage shifts from cautious analysis to promotional cheerleading, creating dangerous feedback loops of speculation. Retail investors begin borrowing against homes and retirement accounts to chase momentum in overvalued assets. This is precisely when smart money begins reducing exposure to popular assets and accumulating contrarian positions. The institutional advantage isn't superior information or analysis, it's emotional discipline and structural patient capital. Now let's discuss implementation, because knowing the strategy means nothing without practical execution steps. Start by calculating your maximum position size in each asset category based on total available investment capital. Cash positions should represent 12 to 24 months of living expenses plus additional opportunity reserves. Research specific distressed debt opportunities through bankruptcy court filings and restructuring announcement databases. For farmland exposure, consider agricultural REITs or direct ownership, depending on capital availability and management capacity. Collectibles require specialized knowledge, so start with categories where you have genuine expertise or strong networks. Countercyclical business investments can be accessed through public stocks or direct business acquisition, depending on scale. The biggest implementation mistake is trying to execute all strategies simultaneously without proper capital allocation planning. Better to execute 2 strategies excellently than 5 strategies poorly due to insufficient capital or attention. Risk management becomes critical because contrarian positioning requires holding power during extended periods of underperformance. Your positions may underperform for months or years before the cycle turns and validates the strategy. This is why emotional discipline and structural advantages matter more than analytical sophistication for contrarian success. Let's examine historical case studies to understand how these strategies performed during actual crisis periods. During the 2008 financial crisis, cash holders could purchase quality assets at 60% discounts. Distressed debt investors who bought bank bonds at 20 cents recovered full value plus equity upside within 3 years. Farmland values continued appreciating throughout the crisis, while residential and commercial real estate collapsed completely. Art auction records show blue-chip works maintained values, while financial assets lost 50% or more. Countercyclical businesses like storage facilities and discount retailers reported record profits during the recession years.
Similar patterns appeared during the dot-com crash, the savings and loan crisis, and every major downturn historically. The strategies work because they're based on human psychology and economic structure rather than temporary market conditions. Understanding the tax implications becomes crucial because different asset categories receive different tax treatment during sales. Capital gains timing, depreciation benefits, and loss harvesting can significantly impact after-tax returns from these strategies. Some assets provide tax advantages during the accumulation phase, others during the disposition phase of the cycle. Professional tax planning becomes essential because improper structure can eliminate much of the strategy's effectiveness. Geographic diversification also matters because different regions experience crisis timing and severity differently. Assets located in politically stable jurisdictions with strong property rights provide additional protection during global instability. Currency considerations become important when assets are denominated in different currencies than your base expenses. The psychological challenge of contrarian investing cannot be understated because it requires acting against social proof constantly. Friends, family, and financial media will consistently question and criticize your positioning during the accumulation phase. This social resistance intensifies as markets continue rising and your defensive positions appear increasingly conservative or foolish. Building conviction requires studying historical precedents and understanding why these patterns repeat across different eras.
The most successful contrarian investors develop independent research capabilities and avoid relying on mainstream financial analysis. Position sizing becomes critical because being right about direction but wrong about timing can still destroy capital. Gradual accumulation over extended periods reduces timing risk while maintaining exposure to eventual opportunity realization. Rebalancing discipline ensures you're buying more of what's getting cheaper and reducing exposure to what's getting expensive. The ultimate goal is positioning capital where it can compound most effectively during the next economic cycle transition. Generational wealth building requires thinking beyond individual market cycles to understand multi-decade structural trends. Each crisis creates opportunities to accelerate wealth building by decades through proper positioning and patient execution. The families and institutions that understand these patterns have used them to build and preserve wealth across centuries. Modern technology and global markets make these strategies more accessible to individual investors than ever before. Information transparency and direct access to assets reduces the traditional barriers that protected institutional advantages. The question becomes whether you'll use this knowledge to position for the next cycle or ignore it until it's too late. Market cycles are mathematical certainties driven by human psychology and structural economic forces that never change. The timing of specific events remains unpredictable, but the sequence and pattern of behaviors remains remarkably consistent. Economic history suggests we're currently in late-cycle conditions, with many traditional valuation metrics at historical extremes. Whether the next downturn arrives in months or years, proper positioning today provides optionality for future opportunities. The cost of being early is opportunity cost on foregone returns from popular assets during continued expansion. The cost of being late is permanent capital loss and missing the greatest wealth-building opportunities of the decade. Smart money consistently chooses the risk of being early over the risk of being late for cyclical opportunities. Building positions gradually over time reduces the impact of being early while maintaining exposure to eventual cycle completion. The strategies revealed today aren't get-rich-quick schemes. They're get-rich systematically over multiple decades approaches. Understanding these patterns gives you the same advantages that institutional investors have used for generations. The next economic downturn will transfer trillions of dollars from unprepared to prepared investors like every crisis before. Your positioning today determines which side of that transfer you'll be on when the cycle completes. Start researching these asset categories immediately and begin building positions appropriate for your capital and risk tolerance. Subscribe for more content on contrarian investing strategies and advanced wealth-building techniques for sophisticated investors. The knowledge exists, the opportunities are forming,